What's up, YouTube? It's the Action Figure Grader coming back to you with another video. This is going to be another general economics video, but I am going to tie it back to collectibles. So I hope you guys enjoy the data I put together for this video. It took some research, and some really interesting data is here in this video that I think supports the idea that we in the US are either already in a recession or a recession is going to be coming really, really soon. And as you're watching this video, I want you to think about how your purchase habits have changed, especially in the last 2 to 3 months. The last 2 to 3 months have seen a pretty major erosion in the US economy, especially the last month or two. And my thinking is that as it relates to collectibles, especially Star Wars collectibles, which is what this channel is focused about, obviously, we've had a massive run-up in prices in collectibles, graded, ungraded, whatever. Everything has really gone up in price because of a number of factors, whether it's Disney Plus content, new collectors entering the collectible space as an alternative investment, the popularity of The Mandalorian and its mainstream success that has reeled in new collectors. All of that stuff has kind of combined, along with high inflation, people wanting to park their money into assets that are hard assets to kind of prevent, the erosion of the value of their dollar as it sits in the bank. All of that stuff is stuff we've talked about. But I want you to think about how your purchase habits have changed, especially with collecting, over the last month or 2 or 3 or however long. Has it changed at all? And my premise, the premise of this video, is that I personally think that we are at a peak in Star Wars collectibles prices. Right now is the peak. June 2022, thereabouts. This is the peak. It might be a little bit longer. We might have just a little bit longer. I don't know. But to me, I think that the writing is on the wall, that everything is going to be coming down. Stocks are already down. Stocks, as you know, are supposed to be a predictor of where the economy is going. Stocks have cratered. They've absolutely cratered over the last 6 months or so. And I think that if you have a 401k or stock account and you get your monthly statements and you see the pretty eye-popping drops that you've seen, the real estate market, we're going to talk about that. That has also slowed pretty dramatically and very quickly. And so I think that the next shoe to drop is going to be collectibles. It's going to be hard asset collectibles. And whether they drop dramatically, whether they just flatten out and kind of have a soft landing, who knows? But in my opinion, we are at the peak of the market for Star Wars collectibles. And I hope to do this video a year from now and be completely wrong. I hope that I'm completely wrong. I hope that my Nostradamus of little plastic dolls proves to be incorrect and we have another year of sustained growth in Star Wars prices. But I think that it's happening already. It's already happening in the comic book market, which we know the comic book market, if you follow it or collect comics at all, that's a much more volatile market because a lot of it's tied to new live action content and movies and things like that. But in general, the comic book market has taken a pretty big hit over the last 2 to 3 months. And I think that it needed to. It was just too high, kind of dating back to 2020, 2021. Everything was peaking. And then kind of August, September of last year, we saw the peak, and it's been slowly dropping since then with some ups and downs depending on the book. But in my opinion, the next shoe to drop is going to be toys. I think that market is going to soften. And if you're still a buyer right now, are you changing your buying habits? So first of all, let's take a look at some recent economic articles that support my argument that we are at or in a recession right now, or one is coming really, really soon. The first article is from Yahoo News, and as always, I'll put a link in the video description to all of these articles in case you are extremely bored, are having trouble sleeping, and want to read these articles, because most people find this kind of stuff boring. I understand that, so I'm trying to keep it more collectibles related. But anyway, The Big Short investor Michael Burry, and if you guys don't know what The Big Short is, that was a movie that had Steve Carell in it, and it talked about the mortgage-backed securities market back in '08 when we had the Great Recession, and he shorted mortgage-backed securities leading up to the Great Recession, and he made a lot of money. He made billions. And according to him, so he's a pretty smart guy. Okay, he's a billionaire. He's a pretty smart guy, much smarter than I am. But he says that he warns that the U.S. economy is on borrowed time, and consumers are blowing through their savings in a matter of months. And the main reason for that is inflation. We've had massive inflation, as I predicted a year ago. If you go back on my channel in June of last year, I said that we are about to have a major inflationary environment, and it's going to affect everything and everybody. I said that at the time, a year ago, the Fed needs to do something now. They did not. They waited to raise interest rates, the federal funds rate, which trickles down and causes a slowing of the economy, a slowing of prices. They didn't do it. They waited too long. And as I predicted, not to toot my own horn, but I did predict all of what we're experiencing right now. I predicted it to the letter. And he's saying that because of inflation, Americans are burning through their savings just to pay for gas. Gas has doubled in price over the last year. Groceries, anything kind of related to living, whether it's utilities or rent or things like that. All of that stuff has just gone through the roof in terms of price. And he said that Americans are going through their savings right now in order to help pay for their living expenses. Once consumers have emptied their savings account, what's going to happen to the U.S. economy? People are going to stop buying. What makes up the U.S. economy? People buying. And 80% or 70-80% of our economy is basically just people spending money. That's what the U.S. economy is. That's what the 70 to 80% of the GDP of the U.S. is related to goods and services being bought and sold. So as people run out of money from paying all these higher prices, they're going to have to cut back. They're going to have to cut back, and they're already doing it now. And he looked at the chart of total U.S. personal savings as a percentage of GDP. The all-time low is at 1.5%, set in July of 2005. And at the last 12 months rate of depletion of savings, between September and December of this year, he predicts that the U.S. consumer, on average, is going to have no savings. And we're gonna get back to that September-December timeframe in a little while here. And this is something I talked about in another video, where a lot of these big wigs on Wall Street, all these big banks, were predicting a recession in the U.S. in late 2023. And this was several months ago when I made this video, and I said they are smoking the crack cocaine. It is going to be way sooner than the end of 2023. He's saying September to December of this year, we could potentially see a major drop in the U.S. economy. He said savings have plunged from over 25% of GDP in the spring of 2021. Think about that. People were saving about a quarter of their money during the height of lockdowns. And the reason for that is all the free money being pumped into the economy by the government. And now it's 3.8%. So we've gone from 25% of GDP is being saved by the U.S. consumer to 3.8%. Think about that massive drop in the savings rate in the U.S. And it could hit a record low of under 1.5% later this year. These are very sobering statistics. And if you think that a U.S. recession isn't coming, this kind of data should scare the heck out of you. It scares me. So that's really interesting. Next up, the Fed's Loretta Mester says inflation hasn't peaked and multiple half-point rate hikes are still needed. This is June 3rd. So this is less than a week old as of the filming of this video on June 9th. What does this mean? Well, the Fed is going to continue to raise interest rates because inflation is still out of control, as I talked about. And because the Fed waited to raise rates too late, they're now having to rate, instead of raising them like a quarter point, they're raising them a half a point each month to try and get inflation under control. And so that concerns me because the rate hikes that they've already implemented have dramatically slowed housing. They've slowed spending and obviously savings. But inflation clearly is still out of control. There's no doubt about that. But the prospect of a quote-unquote soft landing for the U.S. economy is a pipe dream. It is a complete pipe dream because the Fed waited too long, as I've talked about. So what's going to happen is the Fed's going to keep raising interest rates to try and slow down prices. And as a result, they're doing it in such massive spikes that it's going to lead to a massive slowdown. This is the funniest one. Treasury Secretary Janet Yellen tells CNBC the White House was wrong in that inflation was transitory. And this is something I covered. When she said this originally, I covered this in a video, and I said, you are insane. You are clearly insane. This is Janet Yellen, the Treasury Secretary of the U.S., that was saying that. And I said that she was completely insane, and she is a clown. And I was proven correct here. And, so the fact that she's finally admitting, after months and months of record inflation, we're talking 40-year highs in inflation. She's finally saying, oh, yeah, I guess you guys were right. Inflation's not transitory. So they're trying everything they can, but I think it's too little too late, and we're going to have a recession in order to get rid of this inflation. First quarter GDP. This came out on May 26th, so this is a backwards-looking measure, okay? This looks at January to the end of March for the U.S. economy. It declined 1.5%. So it's already here to a certain extent. Now, a recession, technically, is when you have back-to-back quarters of negative GDP growth. So we've already had one, all right? We already had one in the first quarter of 2022. It declined by 1.5%. And I think that the idea of looking at jobless claims and looking at the hiring levels and employment rates as saying the economy's healthy, the economy's fine, the job, and this is what I also talked about. I said that's not the way you measure, because it's a backwards looking statistic. And looking at first quarter GDP, certainly it's a backwards looking statistic, but that means that one of two quarters has already happened that the technical definition for a U.S. recession is in place. So one of two quarters. So this is June 9th right now as of the making of this video. We've got less than a month before the end of the second quarter. And the question is, are we going to see GDP growth? And it's going to be close. It's going to be close. The Fed does track GDP on a real-time basis. And this article came out on June 7th, 2 days ago. It says that the Fed GDP tracker shows the economy could be on the brink of a recession. No kidding. The Atlanta Federal Reserve says that as of right now, the annualized gain of GDP is only 0.9%. Now, again, who knows? Who knows if this holds or not? If it's even just a slight increase in GDP, I would still argue that we're in a recession, okay? I don't care what the technical definition is. Clearly, inflation and all this stuff is affecting people's buying habits. And I know personally, relating it back to collectibles really quickly, I know that I have slowed down. I'm a net seller, really, over the last month or two. I've been selling more than I've been buying, because the writing's on the wall that once the economy slows, there's a lot of collectors out there that are new, all right? I would say over the last 2 to 3 years especially, we've gotten a lot of new Star Wars collectors, and a lot of them are looking for investment grade pieces to kind of diversify their assets or to park money, all that kind of stuff. Well, a lot of those new collectors had no business buying, in my opinion, had no business buying Star Wars collectibles, because they didn't have the savings in place. They didn't have like that emergency fund that I've talked about in past videos. If you don't have a 6-month emergency fund in straight cash and you're buying Star Wars collectibles, you need to reevaluate. You need to reevaluate. You should not be doing that, in my opinion. And as I've talked about, my Star Wars collecting is fun. I love it. But it's not milk money. It's not mortgage money. And there's no way that I would be parking money in Star Wars collectibles or toys or comics or whatever it is you collect without having an emergency fund in place. My emergency fund is a year. That's how serious I take this recession. I learned my lesson after the Great Recession of 07 and 08. I said, I'm never, ever going to not have a year's worth of living expenses ready to go. And I spent 3 years eating and spending very thriftily because I wanted to build up that emergency fund. Now, is a year doable for most people? No, of course not. It's impossible almost for most people to put that kind of money together in a savings plan. But 6 months or even 3 months is doable. And I think that you should have that in place. So anyway, going back to this article, we're already on the brink of a recession. The first quarter was negative 1.5%. The Atlanta Fed says that as of right now, the second quarter is shaping up to be 0.9%. And even I think that's high. Now, when I talked about stagflation in a video a few months back, I had a lot of comments that said I was crazy, that we will never see 1970s stagflation again. And what is stagflation, in case you missed that video? That's an environment, an economic environment where we have high inflation and no growth or negative growth. And I think that's where we are right now. Clearly, we already had it in the first quarter. We had negative growth and we had high inflation. Well, now, this was published on May 25th. The world's largest hedge fund is sounding the alarm over a possible return to 1970s style stagflation. There you go. I said it several months ago. This article just came out, and I think that it's something that you need to think about. That no matter how bad things can get, or how bad things were in the 1970s, could it ever happen again? There's no way. History has an unfortunate habit of repeating itself, and especially when governments control the flow of money, and government institutions like the Fed control monetary policy. They are doomed to repeat their failures, their past failures, and there is a very real chance that we are on the brink of that. And in my opinion, we're probably already there. But it's nice to finally be validated that stagflation is not crazy talk. It's a real thing, and I think we're already kind of in that. Next up, we've got another article that says, and this was published today, June 9th, the recession will hit in the first half of 2023. So they've already moved it up from the end of 2023 to this latest CFO survey. They surveyed chief financial officers from U.S. companies, and they asked them, when is a recession coming? Now they're saying it's the first half of 2023. So we've gone from the end of 2023 to the first half of 2023. I would argue that these CFOs are still living in fantasy land. How about the end of 2022? And that's probably a best case scenario. I think we're already in one personally, as I've already said. Now, I've got a really interesting chart here that I'm going to zoom in a little bit on. As the Fed has raised interest rates, the federal funds rate, the lending rate, that naturally affects interest rates on mortgages, on 30-year mortgages that people use to buy their homes. That's the blue line right here, the Freddie Mac U.S. Mortgage Market Survey for 30-year homeowner loans. And you can see here, since the beginning of 2022, we've gone from about 3% to right now we're at 5%, 5.09% to be exact. So that is what interest rates have done since the beginning of 2022. We've gone up 2 whole percentage points. I don't care what anyone says. I don't care what the math says and what percentage that is and all that kind of thing. Going from 3% to 5%, and we're not done yet, by the way. It'll probably hit 6% sometime later this year. It has an effect on the economy. It naturally has to. And that's why the Fed raised rates, because inflation is so out of control. Housing prices have gotten so out of control. Now let's look at the pending home sales. Pending home sales is the orange line. And they dipped obviously right here during the lockdowns. But since then, it's been a massive spike in homes. Well, now, dating back to the end of 2021, pending home sales are cratering slowly. And by no means is this chart complete, because by the end of 2022, this line is going to continue to go south because mortgage rates have gone up so much, people can afford less house. And houses have already gone up in price so much, so people can afford less house. That's a double whammy on the U.S. buyer of homes. So this line is going to only get worse. The other interesting line is this white line. That is the futures costs of lumber. And obviously lumber spiked during lockdowns because the supply chain was messed up. Plants were closed because of lockdowns. Well, it drove lumber prices way up. And here locally, anecdotally, lumber prices went up 400% in 2021. Well, look what they've done since about the early parts of 2022. They are also cratering. And mind you, they're also getting very close to historical norms for the last 2 or 3 years. So you can look at 2018, 2019, and into the kind of the halfway through 2020. We're getting there. We're getting there. And my guess is that we will see those prices again. We will see 2018 lumber prices very, very shortly, because new home starts, new home construction is going down, new home buyers are staying out of the market, and interest rates are going up. All of this stuff is going to end up causing the U.S. housing market to have a massive drop. And I've already seen it, again, anecdotally, that demand for houses has gone down. And then, this article came out Wednesday, June 8th, yesterday. Mortgage demand falls to the lowest level in 22 years. So the Fed got their wish. The Fed got their wish. By raising rates, they are putting a halt to the housing market, which it needed. It needed a halt. It needed a pause. But this is further proof that we do not have slow, gradual, soft landings. when you have interest rate hikes, it can cause a massive drop very, very quickly. To go from the real estate environment that I was living in the, you know, let's call it the back half of 2021 and into the beginning of this year, to where we are right now, with mortgage demand falling to 22-year lows, that just shows you how quickly by raising the Fed funds rate, it can affect U.S. economic trickle down. And it's just the beginning. The housing market is just the beginning. That's the biggest purchase for most or most U.S. consumers is their home. Think about groceries. Think about everything else. It's all going to be trickled down, and eventually it's going to result in a U.S. recession. It has to. So my caution to you as it relates to collecting all this stuff behind me is, if you have a big ticket item that you're really, really digging, that you really, really want to get, you may want to wait. You may want to wait, because I think by the end of this year, we're going to see a softening in collectibles prices. I think we're at a peak right now. Me personally, I'm buying smaller items because I just think that the writing is on the wall, that eventually it's going to trickle down to Star Wars collectibles, and we are going to see a drop in prices. We have to. We've had too much of a run up too quickly over the last few years, and it's just a matter of time. So let me know what your guys' thoughts are, whether you agree or disagree with my assessment here. Do you think we're at a peak in collectibles prices? Have your buying habits changed? Thanks so much for watching, and I'll be back soon.